This deal is a landmark deal in the sense that it's the first of its kind, at least in the iron ore space, and I believe in the mineral space altogether. And it really unlocks the ability of high capital intensive projects to get into production by leveraging the balance sheet of large organizations such as Vale.
Hello, you're watching Proactive. Joining me today, Cyclone Metals CEO Paul Berend. Paul, very good to speak with you. You've announced a commercial agreement with Vale for your Iron Bear project in Canada that gives you a clear path to production. So, a major milestone for the company.
Yes, so the agreement is essentially a joint venture agreement in two phases. So, over the course of the agreement, Vale can spend up to $138 million US to earn 75% of the project. And at that point in time, at this decision to mine, Vale has the option either to buy out the minority shareholder, aka Cyclone, at fair value. So there's a process there with three independent valuations. Or alternatively, they can carry us into production with no dilution. So that's the high level of the deal. In terms of how it's set up, there's two phases. There's a phase one, which is essentially an option phase, whereby Vale provides us with $18 million US, and that earns them the right to progress to phase two. They don't get any equity in exchange for that investment, unless they elect to proceed to phase two. If they proceed to phase two, they have to commit $120 million US, and once that's been expended, they earn 75% of the project. And then when they take decision to mine, which is obviously at their discretion, they can either buy us out, as I said, or carry us into production with no dilution. So that's essentially the deal in a nutshell.
Paul, is there any sort of timescale to this?
Well, yes, there is. So for phase one, we've notionally got a 12 to 18 months time frame. I'm pretty confident we'll do it closer to 12, starting in January. Once we've completed the work program, Vale has 4 months to elect to go to phase two, only 4 months. And phase two doesn't have a time frame for the work, but it's essentially 2 to 3 years. The reason there isn't a clock in phase two is because we're going to decision to mine. There's an approvals process, and we don't obviously control the timelines for environmental approvals, setting up agreements with First Nations. But once the phase two work program has been completed, then Vale has 6 months to take a decision to carry us through to production or to buy us out. That includes the time to do all the various valuations. So yes, there are clocks. You can't actually stall the the deal. What I'll just say, just to clarify what we're doing with the money, Stefan, because I think that's important. So phase one is essentially completing a work program which includes a large drilling program, a pre-feasibility study, environmental baseline study. So those are the three key elements of phase one. If Vale is happy, which comes out of that, phase two is the bankable feasibility study, impact assessments, studies, as well as all the agreements with the First Nations, which are called, benefit impact agreements, IBAs. That's the term in Canada, and obviously the permits to get into production. So that's phase one. That's phase two. It's essentially a comprehensive program, as you said yourself. It's a pathway to production.
Paul, maybe to take a step back, tell us a little bit about Iron Bear and what you're actually sitting on there.
Now, I think that's important because this deal is a landmark deal in the sense that it's the first of its kind, at least in the iron ore space, and I believe in the mineral space altogether. And it really unlocks the ability of high capital intensive projects to get into production by leveraging the balance sheet of large organizations such as Vale or trading houses, for example. So what makes Iron Bear special, and the reason why Vale is interested in this, is First of all, its scale. You've got a huge mineral resource of 16.6 billion tons at 29.3% Fe. We expect that mineral resource will increase with further exploration to close to 40 billion tons, possibly. So that's speculative, based on magnetics and what we know of the resource. It's got access to infrastructure, so it's 25 k's away from an open access rail connected to an open access port, which does have capacity, although there are complications around it, as there always are. It has access to hydropower, which means extremely cheap energy, which is a key cost driver for magnetite projects, and also a very low carbon footprint. So that's great from a sustainability perspective. And last but not least, and this might be the key here, is it's able to produce an incredibly clean type of magnetite concentrate, which people refer to as a direction reduction grade concentrate, which grades 71.3% Fe and 1.1 to 1.2% silica. And this concentrate can be a feed to make direct reduction pellets, which are a feed to direct reduction steelmaking. And there's two reasons why this is incredibly significant, is direct reduction steelmaking has half the carbon footprint of conventional steelmaking. So it is the only realistic route to get to what people term green steel on a large scale. And essentially, direct reduction units use natural gas instead of coal to make steel, in a nutshell, and they can use hydrogen, in which case you've got zero carbon emission steel. And I can't emphasize how critical that is, Stefan, because 8% of the world CO2, or of all of mankind's CO2 emissions, are actually from steelmaking. So you can make a big dent with something like that. And you need DR pellets to do this, which brings me to my second key reason, is there's only 3 companies in the world which can produce direct reduction pellets, one of them being Vale, IOC, and Samarco. So those are the 3 key suppliers of DR pellets. This market is exploding, of course, because of the shift towards green steel, and DR pellets get phenomenal premiums of over $60 per ton compared to benchmark iron ore, compared to normal iron ore. So if you think of the benchmark iron ore being around 105 USD per ton today, that's broadly what people pay for conventional iron ore, the benchmark. These types of pellets will sell for 170 to 100 to 200 USD per ton, and there's only an additional $15 of conversion costs. So you're really supercharging your profitability, and you're saving the planet. So those are the key characteristics of the project. It's large, it means it moves a needle. It's got a pathway to production via the port and rail. It's low carbon, and it enables you to generate this phenomenal product. So a great project, but it has one massive downside, and that downside, it's very capital intensive. You cannot scale down these projects. You need to spend in excess of $3 to $5 billion US to get something like this into production, which is out of reach of a small organization like ours. And so our strategy, our work program over the last 2 years, and it feels like 20 years to be honest, but over the last 2 years, what we focused on is de-risking the project for an entity like Vale. We built a pilot plant in Quebec City to demonstrate that we could produce these products I just mentioned. And our whole work program was really designed to de-risking it so that a major mining company would want to develop this. And so we had a work program focused on the market rather than the resource. And that's very unique. I think we're the only junior who's ever done that. And that's why we've raised what is frankly a ridiculous amount of money if you look at our market cap, right? There's just no way a company, and prior to this deal, we had a market cap of 10 to $15 million Australian. And then suddenly you raise, 140 or $138 million US, which is about 220 Australian. That's crazy, right? That's surreal. Well, there's actually a reason for that.
Congratulations again on that joint venture agreement. I hope you'll keep us posted on any progress with it.
I'd love to do so.
That's Cyclone Metals CEO Paul Barrett.